Okay, so news is out today that banks are continuing to cut rates on mortgages. They're continuing to fall for the week. HSBC and Barclays actually have become the latest banks to actually cut the cost of their home loans. Now, a third of lenders have actually reintroduced sub 4% 5-year fixed rate deals following mortgage rate cuts by Nationwide and NatWest recently. So what does this all mean? Well, HSBC, for example, has the lowest 5-year fixed rate deal just now, and it's been cut by 0.19 percentage points. It currently offers a market leading rate at 3.95% with a £999 fee. Now, remember, it'll be a higher loan to value rate. What I mean is you've got to put a lot more money down to get that rate. So while it sounds attractive right now, the no, the higher loan to value rates will actually be a lot more expensive overall. But let's give you an idea. At least it's going the right direction and mortgages are coming down overall. Barclays has also announced from tomorrow, it's cutting the lowest 5-year fixed rate deal from 4.04% to 3.84%. So that's good news. Rates cuts have intensified in the last week, actually, with the Bank of England's interest rate cuts for the first time in more than 4 years overall. The central bank has reduced the rates, as if anybody doesn't know, from 5.25 to 5% on the 1st of August. And markets are forecasting a further rate cut this year as well. Good news for the housing market, definitely. HSB is the best buy fixed rate mortgage deal right now, as I said before, at 3.95%, a 5-year fixed rate deal to both home movers as well, and first-time buyers purchasing with at least 40% deposit. See, there's the there's the clincher. So home movers are more likely to have that, have been in their existing house for quite a long time and built up a lot of equity because their loan to value is probably less than 60%, and they will get access to that. So someone securing a rate with a £200,000 mortgage being repaid over 25 years could expect to pay around 1,050 a month. But Barclays has actually gone one better, at least for home movers. It's 3.84% deal aimed at homeowners buying with at least 40% deposit. Is set to lead the market by some distance when it launches on Thursday, which is basically today. Someone with a £200,000 mortgage repaying over 25 years could expect to pay around £1,038 a month with Barclays. Now, I think we hope that these competitive rates will filter up to loan to value brackets to help more borrowers with higher loan to values. And we think that the rates are likely to ignite the property market. So, hopefully that'll get things moving a bit faster than typically usual just now, because the market has slowed down a bit. Run up to a general election, it usually happens. So that's happened and that's all been in place. Now that's out the way. Everybody's still a bit quiet. They're still a bit subdued. We're still in the holiday season for the main holidays for the year, for the schools. When they go back mid-August for Scotland, we'll begin to see the market pick up again as people begin to focus on buying houses again and moving home. And the English market as well will follow at the end of August. They usually typically end their school holidays in the beginning of September or the end of August. Barclays move to cut the mortgage rate sub 4% is a breath of fresh air, definitely, for borrowers, and a welcome boost for the property market overall, I think. It's a bold step and sure to ignite some interest among prospective buyers who have been sitting on the fence, probably waiting for these better rates to arrive. Now is probably the time, and I'll show you why. So we could see better deals coming through in terms of the mortgage markets, given that the average market rate of the 2-year remains fixed at around 5.74%, according to Rate Scrutiny or Money Facts. This will sounds fairly low to many borrowers. Someone securing the Barclays rate at £200,000 over 25 years could expect to pay the 1,080 a month, compared to the market average of 1,257 per month. On top of that, home buyers or homeowners currently remortgaging stand to benefit from Barclays' latest move. Around 700,000 fixed rate deals due to end in the second half of this year, according to UK Finance. Barclays' lowest 5-year fixed rate homeowners remortgage with at least 40% equity, 60% loan to value, is actually leading at 4.06% with a 999 fee for £999. Okay, so new best lender, Empower Mortgages, are charging 4.19%, seen with 25% equity in their home. For people that can get that as low as 4.2% overall with Barclays from tomorrow when fixing for 5 years. Again, the new best lender, as I said, is 4.35%. HSBC is cutting rate for homeowners for the first time in purchasing with a 25% mortgage, as well as rates for these remortgaging. So it is really good. So what is next for mortgage rates overall, are you asking here? Well, mortgage brokers expect more big lenders will follow Barclays and HSBC over the coming days or weeks. This is in part down to lenders competing for new business in order to keep track of the annual targets they've got to hit. Remember, banks are in the business of lending money. They're not in the business of saving money, they're in the business of lending money. So if people aren't borrowing money on huge scale, then they have to stimulate the market by cutting rates to entice people to go ahead and do that, or even switch to another mortgage lender. It's also driven by the money markets as well. You've got to remember the expectations around the future of interest rates, because there's an expectation in the market, there's another interest rate cut to come. I am extremely doubtful about that. Now, tell you why, because you seem to see a lot of wage negotiations currently in mainstream in terms of public servants. And they seem to be quite high in comparative to inflation, which is at 2% right now, core inflation, that is. So there is an inclination that that could affect inflation, maybe in the medium term, or possibly in the short term. So we'll have to see what happens with inflation figures, because the Bank of England, remember, were only swayed with cutting rates from 5.25 to 5% on the 1st of August by two votes swung that. So that one extra vote on the other side against it would have been a split vote, and then it probably would have gone through if the chairman or chairperson had actually voted in favour of cutting rates. But two votes could have swung that quite easily. So it's taken on the edge whether a base rate cut will happen again this year. I mean, these expectations are actually reflected in SONIA swap rates, for example. These are the agreements in which two counterparties, for example, banks, agree to exchange a stream of future fixed interest payments for a stream of future variable payments based on a set amount of money overall. So mortgage lenders are entering these agreements, as I said, and they've been shielding themselves against interest rate risk involved with lending fixed rate mortgages. That's how they're doing it. So they know what they're getting when they're buying from the money markets, and they're doing it based on swap rates. So they've got their fixed amount. So they're not taking any chances, and they want to guarantee their margin that they're making, which is the difference between the fixed rate they're lending to you and the fixed rate they're getting their lending their money at. So they can guarantee their profit overall. They don't want to take these risks of offering trackers and fixed rates, and you often see if they are offering them, they'll be a lot higher than the fixed rate mortgages right now. I mean, put more simply, swap rates show what financial institutions think the future holds concerning interest rates between the banks. As of Monday, 5-year swap rates are 3.57%, and two-year swap rates are 4%. So the money markets are actually quite enthused about where interest rates could be going. This is down from 3.89% and 4.4% respectively at the start of last month, and down from 4.73% and 5.41% a year ago. Every cut counts, I suppose, when it comes to mortgages. So we're heading in the right direction to shape up for an unseasonably busy August, more than likely. There's been commentary as well, while it may be tempting to delay the hope that mortgage rates will actually continue to fall. It's important to stress that nothing is guaranteed, remember. So what I'm saying here is nothing is guaranteed. So really, your decision to buy a property and get a mortgage should be based on your circumstances at that point in time, and not holding off to take what is effectively a gamble whether mortgage rates are going to drop or they're going to go up in the short term for you. Because what happens if you base everything on the fact that you want mortgage rates to drop, and they end up going up again because swap rates change? Leaves you in a difficult position, especially if you're going to fix for 5 years, because they've just gone up and you're going to have to pay that for 5 years now. When if you'd done it now, you could have done it. So the key here is when it comes to mortgages, don't wait. Make sure you continue to move forward with that overall. So how do you find a new mortgage? Let's talk about some pointers to help you. Borrowers who need a mortgage because their current fixed rate deal is ending, or they're buying a home, for example, should explore their options as soon as possible. So, what if you do need a mortgage? Well, they should compare rates, speak to mortgage brokers, and be prepared to act. If you need a mortgage broker, please feel free to message us. We'll be able to put you in touch with the right people. If you're doing buy to let, we've got a mortgage broker for that, specialist. If you're doing a residential mortgage for your own home, we've got a broker for that as well. It would be able to help you out and get the best deals. Often better deals than you can actually get direct with the bank itself. Don't ask me why, but typically it's usually because they give better deals to the mortgage brokers because it's a variable thing in terms of them doing the work for them. Whereas they have to get somebody in their bank, they employ them full time, they have to pay them money. So it often costs a wee bit more to actually get the same mortgage from the bank than it does from a mortgage broker. That's just a rule of thumb overall. Homeowners can lock into a new deal 6 to 9 months in advance, often without no obligation to take it. So remember that. So if you're coming up to the end of your deal that you're in, a fixed rate deal or a tracker or anything like that, or an offset mortgage, then speak to a broker well before that. Maybe 6 to 9 months before that, because you could actually get a better rate, and you could often be able to secure it before the actually deal finishes, just in case mortgage rates are maybe due to increase as a result, and that could hedge it a lot better for you at that point in time. So plan early and start early in your planning. If you fail to plan, you literally plan to fail overall. I would say. Most mortgage deals allow fees to be added to the loan and only be charged when it is actually taken out. This means that borrowers can secure a rate without paying expensive arrangement fees overall. But keep in mind that by doing this and not clearing the fee on the completion, interest will be paid on the fee over the entire term of the loan. So this may not be the best option for everyone. So what happens if you are buying a home then? What happens next? Well, those with home purchases agreed should also aim to secure rates as soon as possible, so they know exactly what their monthly payments will actually be. Buyers should avoid overstretching and be aware that house prices may actually fall as higher mortgage rates limit people's borrowers' ability and buying power. So how do you compare mortgage costs then, if that's the case? The best way to compare mortgage costs and find the right deal is for you to speak to a broker, definitely. I mean, you've got your typical ones online as well. You've got your brokers that work in, your mortgage companies and financial services industry. But you also have your online comparable sites like Compare the Market, or possibly Money Saving Expert, or This Is Money. They've got all long-standing partnerships with various different organisations and banks and building sites in order to look at the best deals for you at that point in time. And then if you want more advice, specialist advice, then definitely speak to a mortgage advisor for that, because they'll be able to work out your affordability and also make sure they answer the questions you otherwise don't know what to ask. I think that is the most important point. You don't know what you don't know, especially if you're starting out for the first time to get a mortgage, and therefore you don't know the questions to ask to get the answers you need in order to plan for your future. I hope that's given you a wee insight into where the mortgages are actually going right now and how it'll stimulate the market. If you need any further questions, as I said before, please feel free to message us direct on this post, or you can contact any one of the offices and we'll be able to refer you to our preferred partners. Okay, until next time, I'm Jim Parker for Fife Properties TV.